Okay, so on the balance sheet, on the liability side of the balance sheet and on the asset side of the balance sheet, we have got current assets and current liabilities. Okay, if you net off one from the other, it is called as net working capital. That's it. Nothing great funda here. Okay, that is actually called as NWC, or it is also called as net working capital. Okay, so normally it should be positive. Okay, if it is positive, it is actually a good sign. So what happens if current liabilities are more than the current assets? Then it is going to be having a negative sign. It is okay. So minus sign is actually not good. Okay, which means you're unable to fulfill your short-term requirements of your company. Okay, that is the reason. Normally, the current asset should be higher than the current liabilities. Okay.
Rajesh Verma.
Just a doubt,
Yeah.
What is non-cash working capital?
Non-cash working capital means the working capital actually having three components. The first one is cash, the second one is inventory, and the third one is cash, inventory, and receivables. These are the three things which are actually makes component of working capital. So okay, so if you take out the cash, then what is actually left there is your receivables and inventory. Okay, this is actually
there are three heads in this balance sheet: account payable, account receivable, and inventory. So all these three are parts of this non-cash working capital.
Excepting cash, everything else is non-cash.
Okay.
Okay, so cash is anyways liquid asset it is. Okay, so apart from that, how much investments you have actually gotten debtors and that is receivables and the inventory is actually going to be called as non-cash working capital it is. Okay, so from this measure, the firm is protected from the liquidity problems. So if the current liabilities are more than the current assets, what happens is the company will be having a sort of a short-term liquidity crisis. Okay, which is actually not a good sign for the companies. For the short-term prospects, it is actually not a good sign. Okay, assets should be more than the liabilities. I'm saying current assets should be more than the current liabilities. It's actually going to be good sign. It is okay. It's something like you got so much of liabilities and you got few amount of cash. Something like that. It is okay. So the financial analysts mean current assets when they speak of working capital. Therefore, their focus is on gross working capital. It is. So financial analysts, if they are speaking working capital means what they are trying to say is they are actually meaning that only current assets. They are not saying that the net working capital it is. Okay. So you have to understand what is the difference between gross working capital and the net working capital. Gross working capital means it's just the current assets. It is. Okay. If I only speak about the current assets which are there on the asset side of the balance sheet, then it is actually called as what? The gross working capital it is. Normally, the financial analysts, they refer current assets only. What do they mean by working capital? They mean only the gross working capital. Okay, so here our concern will be to consider the administration of the firm's current assets, namely the cash and marketable securities, receivables, inventory, and the financing needed to support the current assets. So why is it is important for us? So let us take an example. Okay. So supposing that I live in the era of no UPI. Okay, there is no UPI as such. Assume that you are 30 years ago example it is. So you want to go and have some breakfast. Okay, how much money you keep in your pocket and go for having breakfast?
$200, $300, $100, some
okay.
Extra money.
Okay, so some money you would like to have and go. If you ask me the same question to me, okay, my answer is 2 lakh rupees. Am I wrong in doing that?
No, you just need to have it.
Okay, so there is no need it. I may not need it, but I'm just going with the 2 lakh rupees cash balance and I'll go out and have my breakfast. Nothing wrong in it. Okay, if you extrapolate this example for the companies, okay, so too much of blocking up of your money in the current asset, what happens is you're actually blocking of your assets in the current, means money in the current assets, which means you otherwise you would have actually invested in the long-term assets of the company and you would have actually got a good return on investments. Okay, so simply just keeping for the sake of keeping in the current assets, excess inventories or maybe excess cash, what happens is that is not a good sign for the company, because that decreases the profitability of the company. It is understanding what I'm saying. Okay, that extrapolated example, hope everybody must have understood. Okay. So significance of working capital management. Too low is also problematic. Supposing that I go to a hotel, one of my friend comes, I am having just 200 rupees. Okay, my bill, I know that my bill will actually going to be 500 or 600. So how will I manage my show there? Exactly, you have to extrapolate this example for the companies. Okay, I felt that this much of current assets is sufficient, but when customers are coming and actually they want to purchase something, but I'm saying that stock out. I don't have sufficient stock, which means there is no finished goods inventory at all. So too much is also bad. Too little is also bad for the company. So ideal match is actually we have to have an ideal mix of what is it that then only it is actually going to be good. Okay, significance of working capital management. The current assets of a typical manufacturing firm account for half of the total assets. It is okay. So for a distribution company, they account for even more than half of its total assets. So for some of the companies, like if you are a supermarket or maybe you are actually having an agency wherein you are a super stockist. Okay, so what happens is much of the assets actually going to be more than half of your assets will be your current assets only. It is okay. So excessive levels of current assets can easily result in the firm realizing a substantial return on the investment. Okay, so substandard return on the investment too. So too much of current assets is also bad, but too little of current assets is also bad for the company. That is what we already understood. So, however, the firm with too few current assets may also incur shortages and difficulties in managing or maintaining the smooth operations as well. Okay. So the small companies' current liabilities are the principal source of external financing. Okay. Supposing that I am having a grocery shop. Okay. So what will be my strong source of external financing is the supplier credit only. So what I do is I'll take some 2 bags of tur dal, 2 bags of wheat, or maybe 1 bag of jeera. So what I do is I'll ask for the some credit terms. Okay, just in 30 days I'll give you, or say just in 60 days I'll return your money back. So what I'll do is just in those days, what I do is I'll actually take out I'll make a sales out of it. And what I do is the money, what is it I'm going to generate? I'll be using it for my funding activities. Okay, so if I do it, then principally what I'm doing is for smaller companies, what is happening is the current liabilities are the principal source of external financing. So my supplier credit is actually going to be my major amount of the external financing. What is it I'm actually doing it for the smaller companies? That is how it happens. And these firms do not have access to the long-term capital markets, long-term like debt and debentures, debt markets like debentures and bonds. They cannot really go out and do it, and because of which they're predominantly dependent on the current liabilities, financing through suppliers. So other than to acquire and mortgage on a building, okay. For these reasons, the financial manager and the staff devote a considerable portion of their time to working capital matters. Okay, you have got a department, right? You got a department in the company. The accountant will be responsible for doing the day-to-day activities of your business, right? That particular person who has been appointed, he'll be looking at the matching, right? How much money I am getting and how much, whether I'll be able to tide over this particular gap or not. So that is what is the full-time job of that particular accountant, right? The management of cash, marketable securities, accounts receivables, accounts payables, accruals, and other means of short-term financing is the direct responsibility of the finance manager. So moreover, these management responsibilities require continuous and day-to-day supervision, and you have to monitor on a strict terms. So what happens if you don't have money to pay for the salaries? You are actually going to show a sorry face in front of the employees, right? That is not a good sign at all. So what is that I'm trying to say here is normally you should actually go and these are actually going to happen on a daily basis. A day in and day out, these expenses going to be there. But unlike financing decision, that is what we have seen in case of financing decision. You alter your mix of debt and equity, and you are not going to intervene so much, is it not? And in case of dividend, you take a decision whether to pay out dividend or not, how much I'm supposed to pay out or not. You take a stand and you'll be stick with that decision. Okay, similarly, with respect to investment decision, you'll see whether your project is actually going to be giving you a return more than the hurdle rate or not. You'll see. If it is giving, then you're not going to alter so much. But in case of working capital management, finance manager is actually going to be involved day in and day out. Okay, so if you're not going to manage it efficiently, what happens is your firm is actually forced for the short-term liquidation, right? So that is one of the reasons you have to be keeping in mind. The finance manager's implication is more in case of managing up of the working capital requirement. Okay, so finance managers greater time is devoted in managing the working capital, as we already discussed. So working capital decisions are more fundamental and have implications on the company's risk and return and the share price as well. Okay, supposing that if you are not paid salaries for your employees and if this particular news leaks out, what will happen to your stock price? Imagine. Is it not? Okay. So the types of costs, let us see. What are the various types of costs? You must have already learned it in management accounting. Okay, so variable cost varies with the level of the operations in the company. Fixed costs will not vary, like your rent and all other expenses. They're actually stagnant for whatsoever it is the level of the activity in the company. And there are something called as hybrid costs. Hybrid cost means some part is fixed and some part is variable. Okay, so you know all of this. I'm not going to repeat it. Is it fine? Let me skip this. Fine. Next is which costs are actually called as overhead costs.
Sir, the cost which can be related to only one department or others as well, a common one, but like electricity. So
Sure.
it can,
It belongs to many other what is it the various processes as such, right? So overhead costs are those that are not directly related to a production of goods or services, but they are necessarily for the operations of the business. You can't really say that electricity, what is it I'm using? Okay, so if the electricity bill comes, how much is for the service, how much is for the production of goods? Okay, so you'll be having track of it, but normally it is actually called as the overhead. It is actually called as overhead. It is. Okay, so not directly related to production. Sorry, it is not related to production, but is related to operations of the company. Okay. Okay, so examples of overheads will be utilities, insurance, legal expenses, office supplies, and advertising. All these aspects are actually called as what? Overheads. It is. Okay, so let us now go to the profitability and the risk aspect of it. The two fundamental decision issues for the farmers: the optimal level of investment in the current assets. How much I actually invest in the current asset? Because as we know, we have understood now that by this time, too much is bad, too little is also bad. So how much we are supposed to be keeping as current assets is what is the optimal level of it we should be deciding. Okay, and that appropriate mix of short-term and long-term financing used to support this particular investment in the current assets. And two ways you can actually fund your current assets. Okay, so the first one is you can actually fund through long-term financing or maybe through the short-term financing. What is long-term financing is you can actually go for raising up of debentures and bonds or maybe a bank loan. So that is actually going to be your long-term financing. Short-term financing means I will be managing my current assets with the current liabilities. That is supplier's credit. I'll receive something from somebody else and I'll manage my show. Okay, this is actually called as what short-term financing it is. Okay, so next is risk here means the firm for not maintaining sufficient current asset. What happens? So meet its cash obligations as they occur. You have to be meeting your cash obligations, right? Okay, support the proper level of sales. Okay, so what if your sales want to happen, but you don't have sufficient amount of inventory in the shelves of your market, supermarket? So that is also going to be a worry for that. So you have to strike a balance between the both. That is the reason it is actually called as a profitability and the risk it is. So let us see the current asset levels for the three alternative working capital policies. Okay, so let us now say that there are three types of working capital policies: policy A, B, and C. Okay, so what is the policy A and B and C is, you can see the liquidity is high in case of policy A, which means your current assets, investment in current assets is more in case of policy A. In case of policy B, current assets are less. And in case of policy B, it is lesser than the policy B it is. Okay, policy A means you've got a huge amount of investment in the current assets. Policy C means you've got a less amount of current assets which are there in your investment in the current assets, and B is something in between A and C. Okay. In determining the appropriate amount or level of current assets, the management must consider the trade-off between the profitability and the risk it is. Okay. Though policy A clearly provides the highest liquidity, how do the three alternate policies rank when we shift our attention to expected profitability? Okay, if you ask me, maybe as a finance manager, maybe you are interested in policy A because you got more amount of current assets and easily you can actually manage your day-to-day affairs of the company. But that comes with the cost. That actually comes with the cost, right? Okay, so to answer this question, we need to replay on the familiar return on investment equation. It is right. What is return on investment? It is net profit divided by the total assets. It is okay. Net profits divided by assets means cash, receivables. Your inventory is going to be your working capital plus fixed assets. Okay, what is the total amount of profitability you'll be generating out of your total assets? Okay, that is actually going to be your return on investment. So if you want your return on investment to be on a higher side, okay, what kind of a policy of working capital you should be having? Whether you should go for A policy, B or C is the question. What is that we have in front of us? Okay, so from the equation, we can see that decreasing the amount of current assets held will increase our potential profitability. Okay, so let us go back. So if you decrease your total assets, means by any chance if you could decrease your current the working capital requirements, obviously your numerator will go up, is it not? So lesser the denominator, more will be your resultant figure. It is, in other words. Okay, so so policy C then provides the highest profitability potential as measured by ROI, is it not? If you go for policy C, less current assets, more profitability. Okay, however, the moment from the policy A towards policy C result in other effects besides increased profitability, is it not? So decreasing cash reduces the firm's ability to meet financial obligation as they come due. Okay, so decreasing and increasing have got their own merits and demerits. That is what we have understood. Okay, so if you want liquidity concerns, okay, so policy is actually better. If you've got profitability as a concern, then policy C is actually better. But if you really see the risk level of the company, then policy C is actually going to be high risk. It is. Okay, policy A has got low risk. It is. Okay, so you have to strike a balance between all the three. And what is really going to be helpful, your finance manager is supposed to be doing it, and how it can be done. We'll be taking up a few problems. In this particular session, we'll be understanding how to go about the same. Okay, so interestingly, our discussion of working capital policies have just illustrated the two most basic principles in finance. Profitability varies inversely with the liquidity, right? If the liquidity is high, the profitability will be low. Okay, if the profitability and you understood that profitability moves together with the risk, it is. Okay, if the risk is higher, if the profitability is going to go higher, risk is higher, which means you are actually managing with policy C. It is, risk is higher, right? Okay, so ultimately the optimum level of each current asset will be determined by the management's attitude to the trade-off between the profitability and the risk. So there is
Sir, in this case,
yeah.
Sorry for interruption.
Yeah.
So in this case, like if profitability will be low, so in that case, risk will also be low.
If the profitability is high, risk is high, right? Because you are planning to go for the policy C, the risk is high.
Okay.
Risk is high in policy C. So profitability is also high in policy C, right? That is the reason it has been said that profitability moves together with the risk. Okay, when you take a risk, there is high profits. Okay, that is in other words, right?
Sir, can you please go to the previous slide once? So here it is fine, but what about policy A? It also says that it's high on liquidity.
Liquidity high, but you are going to suffer on the profitability because policy has got low profitability.
Okay.
Because you want to have more liquidity means you are investing more assets in the current assets. more amount you are keeping in the current asset, and because of which what happens, that decreases the profitability.
Okay.
Okay, so policy C means what? Policy C means you got less investment in the current asset, and because of which the profitability is actually going to be high there. But risk is more in policy C. That is the reason we have to strike a balance between policy and policy C. Maybe midway is actually going to be better. It is. Okay. It's all theory what we are discussing, but how you actually handle it is what we have to be discussing. We'll be discussing very soon. Okay. So classification of working capital. Okay. So it's only a classification. It is. So supposing that you should actually go with the permanent current assets. Okay. So how to actually handle this? We are discussing now how to handle this. Okay. So permanent assets, current assets should be a major portion of your current assets should be permanent current assets, and your fluctuations, whatever it is happening on a seasonal basis, that can be financed to your short-term financing needs. Okay, maybe with the term loan, or maybe with the bank overdraft, or maybe with the supplier's credit, you can actually manage it. Okay, that is all about this. How we can actually manage this is about like this it is. And next is what I'll show you one more thing. Okay. So this is one more thing where it is you are going to finance with the fixed assets, and also you are going to finance with the current assets, and whatever the seasonality which is actually coming up, you are actually going to go with the short-term financing, maybe overdraft or maybe supplier's credit and whatnot. Okay, so these are actually going to be, these are the ways and means you can actually balance your the profitability, because you want more profitability, and at the same time you want to check have a balance of current assets also, and your company should not be go into short-term liquidity crisis as well. So you have to make strike a balance between all of this. I think this much of discussion is sufficient, and other things you'll be able to manage if you go through this particular set, which I'll be posting soon after the completion of the session. Okay. So what we do now is we'll go and take up a few numerical problems. Okay, so how to assess the current assets and all that. So that we'll be doing it now. Just a minute. Yeah, you guys can actually go to Moodle now, LMS. And can you please download this the file which is there in the session 15? You can see session 15 handout problem set WCM. Can you just download this? Is it there?
Yes, sir, got it.
Yes, sir.
Yeah, so please download it and open Excel sheet as well. There are few problems here. So I just crop this first problem. So I'll move to Excel. I'll open Excel. Is the Excel is visible?
Yes, sir.
Yes. Okay, so let us now start with the problem now. So please concentrate. It is very easy problem. It is only thing is here and there hiccups will come up. Okay, it is not like time value of many problems. It is. So it's a lengthy problem. It will be, but a very easy one. Okay, a company is currently operating at 60% level. So I'll keep writing whatever I read it in the problem. Okay. So right now the currently the company is operating at 60% level. Production 36,000 units of product proposes to increase in the capacity utilization in the coming year by 1/3. So right now there are 36,000 units are produced. Okay, but company wants to utilize the capacity by 1/3. Okay, so which means how much is that? Can you compute that? Multiplied by 1 plus 1/3. Are you getting this much? Confirm. Add 1/3 to 60%. Okay. Are you getting 48,000? How many are you getting? Which means the number of units will be 48,000, right? Or you can choose to do 1 divided by 3 as well. So which means the company wants to go for 33.3333%. So 36,000 multiplied by 1 plus this. So you're getting this 48,000. How many of you got 48,000? Just put it in the chat box as yes.
Yes.
Good. So many participants are doing it. I'm happy about it. Okay. Fine. So let us now go towards the next. The following data has been supplied to us. Okay, so this is the cost structure per unit it is. Okay, so cost structure means there is going to be a product they are going to manufacture. Okay, this is the cost structure. The raw material is going to be costing them 80 rupees. Okay, wages which are variable in nature will cost 40 rupees per unit. Overheads which are actually variable in nature will cost 40 rupees per unit. Okay, fixed overheads will cost 20 rupees per unit it is. Profit is actually 60 rupees. Okay, so profit at this particular level is actually going to be 60 rupees. Selling price is 240 rupees. Okay, so how we got selling price is your total profit, sorry, total cost price plus profit. If you add a profit of 60, you'll get 240 rupees. Okay, how you'll get profit? Selling price minus the total cost price per unit. If you do it, you'll get the profit. You know, it is easy statement, right? So how you get profit? So profit is equal to selling price per unit minus cost price per unit, right? How we get the selling price? SP stands for selling price. Cost per unit plus profit per unit, you'll get the selling price per unit. Okay. These are very commonsensical things, in other words. Let us see what is there in the additional information. Okay, so the raw material will remain in stores for 1 month before being issued for the production. Before they issued for the production, the raw material stays in the stores itself. Okay, that is the information what we got. So raw material will remain in the process for further 1 month. What do you mean by process? It is work in progress. It is. Okay, so the raw material will become a finished product. Okay, after 1 month staying in the work in progress. Okay, that is what it is given there. Okay, so supplier will grant 3 months credit to the company. So supplier credit will be how much? 3 months it is. Finished goods remain in the stores for 1 month. So once when the complete production happens, okay, that is actually called as a finished product. That finished products again, on an average, will stay in the company itself. Company's warehouse, it will be there in the warehouse itself. That is in the stores of the company for 1 month. Because the moment you manufacture a car, that does not mean that the car will be sold off immediately, right? It may be lying in the warehouse, or maybe it is there in the for some time laying in the, maybe there in the what is it, the showroom. After that, it is actually going to be getting sold. Once it is sold, then only it is accounted as sales. It is until such time it is actually there in the inventory itself, right? Next is debtors are allowed for credit for 2 months. Okay, so whatever the debtors, what is it the company has got, so there are companies actually providing for 2 months. Okay, so but from the suppliers it is getting 3 months credit. It's an advantage, right, for the company. You're getting a credit for 3 months, but you're giving you're selling your finished product, okay, and you're actually saying that 2 months is the credit limit, which is actually an advantageous. Companies in the advantageous position here. Next is average time lag in the payment of wages and overheads is 1 month. Expenses accrue every evenly throughout the production cycle. That is what is the additional information given to us. Let us see how to counter this additional information. Next is selling price is estimated to be increased by 10%. Okay, so which means 240 plus 10%. Okay, 264 will be the new selling price, that is right. You are required to prepare projected profitability statement, a statement showing the working capital requirement at the new level of units, that is 48,000 level, assuming the minimum cash balance that is been there in the current assets is 50,000. Okay, so let us now go and solve this. Hope you have understood this problem to at least to the tune of 60-70%. Right? Okay, so let us now go for the cost per unit. Okay, our cost structure computation of cost and profitability per unit basis. Okay, so let us use the same structure what we have. Okay, so I'm writing whatever it is given in the cost structure per unit, raw materials. Okay, so I'll be having I'm going to write it as amount that is in INR. Okay, and this is my particulars. These are my headings. So raw material. So before that, I'll just add one row here, because I'll write here 48,000, because I should be having information how many units I have. 48,000 units. So I'm keeping both in the different cells, because I can use it whenever I wanted this 48,000. Okay. So raw material per unit, it is how much? Okay. So this is per unit it is given as 80 rupees. Okay, so I'll make it as here. Okay, here I'll write it as per unit. I'm just changing slightly, because I want both per unit as well as for total of 48,000 units as well. So I'll just copy and paste this here. Okay, so how much is raw material now? Total raw material will be how much? So this is 80 multiplied by 48,000. Okay. So next is wages variable. So 40, I'll write here. And I just dragged down this because I already put dollar symbol, right? Next is overheads. Variable overheads. So unit cost is 40. Variable overhead, right? Next comes fixed overhead. So fixed overhead, you should be quite careful. Don't do it on a per unit basis. It is okay. So multiply this fixed overhead by what is the fixed overhead? It is 20, right?
But we can multiply this with 36,000.
Yes. So this we multiply with 36,000. We got this much, right? And this we will divide it this by total number of units. We'll do ulta. That's it. So now what has happened here is my fixed overhead came down because as and when I produce more number of units, my fixed overhead will come down. This is the property of a fixed overhead, right? So we have actually retained that quality of this. Okay. Is it clear? Any doubts are there?
So could you repeat the fixed overhead part once more, please?
Yeah. So fixed overhead means what you have to understand. So this fixed overhead per unit, they must have computed at this 20 rupees for 36,000 units. Just because
Okay.
you go and produce 48,000 units, unit price will not, that is actually fixed, in other words, right?
Hmm.
So that is the reason what I did is 20 multiplied by 36,000 I did.
36. Understood. Yes.
And then what I did is this I divided by 48,000, which means I retained the fixed overheads, what is it? The nature of fixed overheads, the way it is. Okay.
Means, sir, my overhead expense came down due to my
Came down.
overproduction.
Yeah, well, not overproduction. Since my
Increased production.
production has increased, yeah,
Yes.
increase is the right word to use.
Yes, sir.
Yeah. So next is what? So next comes the profit, right? So
Selling price.
profit. Before profit, we should also fix the selling price, right? So selling price means what they are saying is 240 is the old price, and you have to multiply that with 1 plus 10%, right? You get 264. So why is that 264 now? Because the selling price is going to increase by 10%. That is the reason we did this. So can you now compute the profit? So how to find out the profit? Profit is equal to selling price minus,
All the cost.
yes. So this minus sum of all this. Is it correct? See, I am getting 89 rupees as profit. How much are you getting?
Same, sir.
Same, na? Okay. Yeah, so everybody are getting the same. Sachin, Som, Varun, yeah. Naresh. All getting 89. Deepesh, yeah. It
Sir,
is
can
easy,
you
as I
please
told you.
click on profit once? Okay, fine.
Okay, so we are done with this. Cost per unit and the profit per unit, we are actually intact now. Okay, so it is matching, yes. So now, so projected profitability statement, we are done with this. Second is the statement showing the working capital requirement at new level, assuming that minimum cash balance is 50,000. The second one we are supposed to do now. Okay, so let us now write heading. Computation of working capital requirement. Or we can also write it as statement showing working capital requirements as well. Okay, so in case of working capital requirement, okay, we should be writing first item is point number A, or point number A is current asset. Okay, so let us make bold. And next is current liabilities. Somewhere I'll leave some space. I don't know how many rows it might take. Current liabilities I'll write. So what I should be doing now is I should be listing out all the current asset with the amounts and the current liabilities with the amounts. Okay. So once I come to know how much is my current assets and current liabilities, I should make a total of it. Total current assets, total current liabilities. After that, what should I do? I should compute net working capital, which means current assets, that is total current assets minus total current liabilities. If I do, I'll get to have an information that how much is the net working capital required. Okay. Is it fine? This is what we'll be adopting. So we'll be going for amount and INR. Let us just copy this and paste it here. This is my inner column and this is my outer column. You must have seen in case of accounting, we have got inner column and outer column, right? Do you remember?
Yes, credit debit.
Not credit debit, inner column and outer column. So we
Okay.
quote it and we'll put the somewhere outside here in the outer column. Okay, anyways, you'll be learning if you don't know what is it. Okay, so let us go to the first item now. Additional information. Okay, so raw material will remain in the stores for 1 month before being used for the production. Okay, so raw material I'll write here. So raw material, I'll go to outer column. Okay, so it will stay in the stores for 1 month. So how should I do for this is, so 1 month means complete is actually going to be complete raw material 38 lakhs and 40,000 is for entire year it is. For 1 month, how to compute is 1 by 12 it is. Is it fine?
Yes, sir.
Given as 1 month, so I have to go divide by 1 by 12 multiplied by 38 lakh 40,000. Okay, I press here, enter. So I got answer as 3,20,000 worth of it will be staying in the stores before it is actually moving to the production. So that is what I have actually taken care of this. Okay. So why I'm not writing here and why I'm writing here is you'll come to know when I go for the next item, because some calculation is supposed to be made and then the total should go here. That is the reason we have made 2 columns here. This is inner column and this is outer column. Okay. So second is raw material will remain in the process for the further 1 month. Okay. So once it goes for the production from the stores it is issued to the production. In the production, work in progress will take place 1 month. Okay, so which means I'll write it here, work in progress. And that is my heading it is. That is my heading it is. Work in progress, make it bold. Okay, so work in progress, what is that they have said here is raw material will remain in the process for 1 month. If the raw material is in process for 1 month, okay, whatever it has been attached to the raw material will be in the stores. We will also be in the process for the next 1 month. Okay, so that is wages, overheads, fixed overheads, everything else will also be there in the process. Okay, so I'll write it now, raw material. So raw material, how much they're saying the work in progress is for 1 month. So what we'll do now is, so 1 month is 1 divided by 12 multiplied by this amount. Okay. So I'm actually taking it as raw material is in process. Next is wages. If raw material is in process, wages will also be in process, right? Because everything is attached to materials it is. So because of which I'll be writing it as wages variable. Okay. And how much it will be in process? One month only it is. 1 divided by 12 multiplied by wages. I'll pick up this and I click enter. So wages is also in work in progress. Okay, just only material will not be there. Work if since everything else is attached to the materials, okay, every other thing will be there in the work in progress. Next is overheads. Next item is overheads. So how much is this? Again, it is also 1 month. So multiplied by overheads variable. Next is fixed overheads. So the fixed overheads are 720. So 1 by 12 multiplied by 720. So fixed overheads are also we have done. So can you total it up now? How much is this? So I'll go and pick up this line, thick line. Okay. So I'll make summation of this now. Which means the total work in progress, value of total work in progress is 7 lakhs. Instead of making all these calculations here, okay, so I'm making it here and I'm saying that 7 lakhs, which means the total value of the work in progress is 7 lakhs. That is how I tell it. Is it fine?
Sir, one thing I want to ask, what is the cycle of the working capital for which we are calculating?
So the cycle of the working capital, it ranges from 1 month to 3 months. That is what I could say by looking at this additional information.
Yes.
Because you can see supplier credit is 3 months, whereas your debtors, you're actually giving credit for 2 months.
Too much.
That is what we discussed already. And you can see finished product also stays in a month for a month as such. So we can say it is more than a month and less than 3 months it is. Cycle is.
But sir, we are calculating for 1 month, assuming the
We are
raw material
calculating for 1 month because it is given it is in 1 month. But there are some of the items which are there for 2 months as well. You can see here. Not every other item is 1 month. Okay, but you're asking for a total cycle of the working capital.
Yes, sir.
Yeah, so it is, I can say that it is slightly more than 1 month. Okay.
Okay.
Okay, so next item, let us go to the raw material in the stores we have discussed already. Second item, the raw material will remain in the process also we have discussed. Next is supplier grant 3 months credit to the company. So this is the item of the current liabilities, right? So suppliers credit, I'll go write it here. Okay, so I can, since there is only one item, I can go write it in the outer column. So how much is supplier credit it is? 3 months it is. On what?
From raw material cost.
So 1 divided by 3
4.
divided by the, sorry, this is 3 months, right? 3 by 12, right?
Yeah, that will be 4.
3 by 12 or 1 divided by 4 it is. Both are same. Okay, so 3 by 12 I wrote. Okay, suppliers are actually giving us the raw material. So raw material, I'll just go click raw material. I click enter. Is it fine? Let us go to the next one. Finished goods remain in the store for 1 month. Finished goods So finished goods which are there for 1 divided by 12. But finished goods, which on which item I am supposed to be doing it? Any idea?
Selling price.
Selling price.
Yeah.
Selling
So
price.
normally it is actually done on the cost price. Okay. The finished goods is net to cost, not on the selling price. Okay. So what I do is I'll sum multiplied by. Are you getting 7 lakhs?
It is equal to WIP. Same is in same code.
Yes, yes,
Sir,
yes.
we can minus profit from selling price. That will also be CP.
Yes.
Yes, yes, yes. We can. There are multiple
is
ways
also
of doing it. Yeah, yeah. Whichever the way convenient, you can do it. Okay, this minus this is an easier one. Finished goods. So debtors are allowed for a credit for 2 months. So I'll go right here debtors. So I'll go to outer column. 2 months, na it is. It is 2 divided by 12. 2 divided by 12 multiplied by debtors. Tell me on what we have to be doing it.
Selling price.
It should be on the selling price. Very good. So on this price. Okay. Okay. So debtors done. Average time lag in the payment of wages and overheads. It is. Okay. So time lag means it's a liability, right? So time lag means you're taking more time, means it is liability. It is. So time lag in the payment of wages. I'll write it here as time lag wages. So how much is wages? So time lag in the form of wages is how much is that? How much is the time lag? 1 month, right? So 1 month divided by 12 multiplied by wages. This is the time lag for wages. And time lag for overheads. How to do this? 1 divided by 12 multiplied by overheads means you got both variable as well as fixed. So I'm taking both. I'm taking both and I press enter. I'm getting 2,20,000. Is it matching with your answer? My answer?
Yes, sir.
Okay. Fine. So we have done with the time lag of expenses with the wages and overheads. Next is selling price. We have taken into consideration of that. And you can see the statement showing the working capital requirement at the new level, assuming that the minimum cash balance is 50,000. So they have said that based on their experience, cash balance should be for any other contingencies, they want to keep it as 50,000 cash balance plus. So now can you tell me how much is the total of the current assets? So sum it up. This is the total of the current assets and the total of the current liabilities. Total of the current liabilities is. Okay, so now you can write it as a net working capital. Capital is also called as NWC in short. Okay. So that is excess of current assets over current liabilities is your net working capital. So through this problem, what you'll understand is how much I should be keeping in the current assets. You will know. Okay, so as a finance manager, you'll be having an information that 38 lakhs and 82,000 of current asset you should maintain to run your show. Okay, so that is what is the outcome of this. Any doubts here, class? Simple one it is. And you got idea about what are current assets and current liabilities and how finance manager typically does it. Maybe in the practical scenario, you'll be running with so many items as such. We have got only few items here in this problem. Okay, so in the real life situation, you'll be having n number of items and problems in doing it. It may not be that easy cakewalk in case of a practical scenario, but the funda remains the same. Okay, you should keep much of the current assets because you don't know how much is actually going to be the money you'll be spending it and all that. Okay, so can you go to the second problem and do it on your own here right now?
Sir, one second.
It's been finished.
Yeah,
about
go ahead.
once.
Sorry.
For the
Sir,
final,
can you
is
click on
24
total current? Sorry.
Sir, my question is, as a company, for this company, this question that the final net working capital is this 25 lakh 42,000. That is what they should keep.
Yeah, working capital is coming up to 25 lakhs 42,000, but you should have current assets to the tune of almost 39 lakhs. Then only you'll be able to see 13 lakh 40,000 is there, but you are actually going to be keeping this much cash is really required for it. Okay, it is coming from 13 lakh 40 coming from the current liabilities. Okay, so rest you have to keep this much.
Okay.
So how are you going to finance this? This financing can happen. There are two ways of financing we have discussed. How? Tell me. Dinesh?
Sir, debt or equity. So this will be probably current debt.
No, we have discussed two ways it can be financed. One is short term, the other one is long term.
So short term debt
Long term is actually what?
for
Either,
capital investment.
either
Fixed
through
for
equity
fixed
or maybe
asset.
through debt.
Yes.
Okay. Short term means you'll be going for a OD, or you would like to go for financing happens from the current liabilities, suppliers credit and etc. We have discussed. Right? Yeah.
And
Anything else? Yeah. Any other question before we move on to the next? Okay. So go to the next problem number 2. So do it in front of me. Let's see. Yeah, please do this. First time I'm getting some time. I'm giving you some extra work in the class.
So 4 weeks can be taken as 1 month, or we have to break it into weeks, sir?
Yeah, 2 divided by 52 because 52 is given there.
All right.
4 divided by 52 and so on.
Lag in payment of wages, sir. How would you do that? 1.5 weeks.
Pardon?
Lag in payment of wages. That is 1.5 weeks, 1.5 weeks.
1.5 divided by 52.
Sir, we have to calculate NWC. Is
Yes.
it 64 lakh 95,500?
And to add that, to that you have to add 10%.
That is after adding 10%.
Correct. That's it. Done?
Yes, sir.
Okay, good.
My answer is different. It's 60,92,000.
Good. Whether I am calculating correctly, somebody can validate my answer.
So far, I don't know if mine is correct, but so far mine is,
No, so far mine is correct.
yes, so far mine is correct.
Yes, sir. So far it's matching.
Matching, that's it.
It's matching. Yes.
Nothing is correct here, it's matching, that's it. Obviously, we are doing it, solving it.
Um,
Okay, Dinesh sir has done it already. Good. So also done. Very good. Deepesh also done. Good. Raw material. So let me come to outer column. 4 divided by 12 sorry, 52 it is. Multiplied by raw material. Next is raw material will be in process. Okay, so this is work in progress. So work in progress, I'll just copy all of this. I paste it here. So I go to inner column. This 4 divided by 52 multiplied by raw material. So it is the same order. I can double click. Is matching. So work in progress. Finished goods in stock. So finished goods means it is cost price, right? Okay, so next is credit allowed to suppliers. So supplier credit is on raw material. Four weeks. So 4 by 12, sorry, 52 raw material. Debtors. So debtors is 8 weeks. 8 by 12, sorry, 52. So debtors means on a finished, that is on the selling price. Bag in the payment of wages. $1.5 weeks divided by 52 multiplied by wages. So direct labor it is. Cash 75.
The finished good. Finished good.
Pardon?
Finished good calculation, right?
You're asking me?
Yes, sir. Yes, sir.
Tell me.
I'm also not goods.
FG.
176.80. How do we get that? JLM minus 10.
Multiply with some factor also. This
Finished
will be
goods in stock is what?
4 ways. 4
Cost
by
per
52.
rate
You
is
have not
plus-
multiplied with 4 by 50.
Selling price minus
So you have to multiply with or divide with 13.
4 by 12. 4 by 52.
divided by 4 divided by.
32. Yes.
Is it matching?
4 by 52. 1363.
Yes, sir.
Okay. So time lag is over. This is over. Next is. That's it. No, nothing else is there in this. So total current assets.
Time lag overheads. Oh,
Is it done?
Sir, can you please click on the formula for time lag and supply credit
Yes, it's matching.
Matching.
Yes.
into cases?
Raw material, it is 83 lakhs 20,000 it is. Time lag is 1.5 divided by 52 multiplied by K7. Labor it is. So next is this is B, current liabilities. Next is NWC. Is equal to current assets minus current liabilities. And add 10% for contingencies. So this is it is grand total. So 64.95. How many of you got? I think
Yes.
Sachin Verma has got 56.37. So majority of our answers are matching, right? Okay.
So mine is also actually what I did was that the direct labor 2,40,000 which you have calculated, I did 1.5 by 52 over there.
Okay.
So instead of this current liabilities, so that will be for 4 weeks you have considered
4 weeks. 4 divided by 52 it is.
direct labor in this your J19.
J19.
4 by 52. So that is for 4 weeks you have taken. Why is that so?
Direct labor. Okay. The raw material in process is for 4 weeks, right? So with raw material, you have got many other things attached to it. That is what we
Okay,
discussed.
right.
We
Correct.
discussed, right?
Yes.
So that's all from my side. So thank you for being with me. So we've got last one more class to go. So we'll have that in the next coming Saturday. Fine.
Right.
Thank you,
That
sir.
is a single
Thank you,
class.
sir.
What we'll be doing in that? That is a single class.
That is a single class and we'll be discussing about the derivatives, financial derivatives.
Okay.
Fine.
Okay, sir.
Bye.
Thank you, sir.
Good night.
Good night. Thank you.